meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his newest expert, Taylor from Life Goal Investments. How you doing, buddy?
I'm doing great. Thanks so much for always having me. This is a pleasure.
Oh, I love talking to you. You got the experience of Wall Street, which I don't have. We can marry it with my real estate experience. It's often a great conversation. What I want to talk about here is I have said for 6 weeks now that the Fed broke housing, right? Too low for too long. We've now got everybody with 3% mortgages, supply destruction, demand destruction. Fed broke it. I now believe they've also broken the stock market. Too much risk, too much leverage, all of this stuff. As I sit here and I was getting ready for our discussion, what I really think happened is the Fed took risk to zero or even negative, really. What do you think about that? Did the Fed really take the risk or risk capital to zero?
Yeah. When you have rates at zero, there is no reason that you don't go out and leverage yourself and go out and buy whatever asset it is. It doesn't have to be a high risk asset for you to make the margin between the two. If you can go out and finance at 3%, that's that watermark. That's all you have to get over to start seeing positive real returns. Mm-hmm. And that's what corporations do. Corporations look at each other and go, hey, I can finance this next growth project that might net me an 8% return. And if I can do that and only pay 2.5%, mm-hmm. I'm in because I'm netting that 5.5% different. Yeah. But when they take the punch bowl away and they start to ratchet up that bottom line, if you can go out and grow at 8% and all of a sudden the cost of borrowing is at 5.5%, now you're looking at going, I only have 2.5% of buffer there. I better be right. My projections better be darn good or I'm not going to make money here.
Yeah. Something that's very, very obvious in hindsight, which it often is the TINA trade, right? There is no alternative, has really been the cause of a lot of the kind of asset inflation we've seen, the stock market, crypto, even real estate, commercial. Yep. I mean, I'm seeing some commercial deals done the last couple of years that I'm sure don't pencil in today's rate environment. And unfortunately for them, their debt structure forces them to refi into a rising rate environment. So I think there's a bunch of pain ahead as risk is repriced. And I think we talked about it last week. You get the 10-year or heaven forbid the 5-year to 3%. There's a lot of people who are like, check, I'm good, right? They're not going to put the money anywhere else, right?
Yeah, you're exactly right. And it's interesting because on the other side, so like I'll create the excuse for the Fed because I know people are banging them over their head, and rightfully so. They waited too long. They used the word transitory. They dug their heels in on they said inflation's transitory.
Yeah.
And everybody knew at that point that the writing was on the wall. Inflation was not transitory. But I've spoken a little bit about this in the past, but the excuse for the Fed is that if the Fed raises rates too quickly, mm-hmm. coming out of a pandemic, and we roll back into another variant that's lockdown type procedure, et cetera, they could force us into a deflationary environment.
Yeah.
And that is the worst economic environment you could ever be in. And this sounds like the world's greatest problem, like things cost less, right? And that sounds awesome. But at the end of the day, people don't spend money if they know they can hold on to their money and spend it later on down the road and buy it at a cheaper price. Mm-hmm. So the problem is Japan was in a deflationary spiral for 30 years. Their economy literally did nothing. They went from being, I think, a 40% of world market cap in the 80s, somewhere around that ballpark, to being mm-hmm. like 10, being, a non-event at the end of the day. Mm-hmm. And so, don't quote me on those numbers, but they're directional. Yeah. So deflation is really scary. And it's something that the Fed and was extremely worried about because Japan couldn't fix it for 30 years.
Yeah.
On the other side, they look at it and said, if we get behind the ball on inflation, yes, that sucks. Yes, that means prices get away from us. And that's absolutely what's happening right now. But they go, we can fix it. Yeah. We can raise rates enough to force things into a recession, and that'll correct itself. So that's where we're at, unfortunately. And I think you and I both feel that that's legitimately what's going to play out.
So you do see the end of this being what you would see media call a hard landing, aka a recession. We just have to suffer through one.
Yeah, it doesn't have. We've discussed this a little bit in the past, you and I, Michael, that you expect a little bit harder of a recession because mm-hmm. you think that the Fed can take rates higher than I think they're going to be able to get. Mm-hmm. So that'll mean that they get higher, and that'll cause a longer tail and a longer drawdown. I think they break the economy sooner. which is kind of a weird thing to say, is I think the economy is slightly weaker than you, and therefore our recession will be slower or shorter term rather.
Okay.
But yes, I think that there's a very low likelihood that they're able to tighten the way that we need them to, because inflation is where it is, without breaking the economy and forcing into a recession. And a recession, by definition, is 2 quarters of negative GDP growth. And that doesn't mean they need to be significant drawdowns and 8 quarters in a row. It could be 2-3 quarters of a little bit downward GDP. And that's what I see as most likely.
Yeah. So again, I agree with you that deflation is the great boogeyman for the Fed. I got to tell you, I don't think they feel really good about stagflation, which is again,
that's fair. The economy doesn't grow and inflation's rampant.
Yeah. And that's
not a good situation either. You're right.
Yeah. So that's, again, everything will be known in hindsight, right? We're recording this, whatever it is, April 25th, 22. This probably won't be known until, 2024. But I think 2022 is going to be known as the year of stagflation. Yeah. What do you think?
Yeah, I think you're right. I think we're seeing we're not seeing a shrinking in our economy, but we're seeing a slowdown of growth.
Yeah.
And hyperinflation is definitely not the right word. It feels like hyperinflation because we haven't had inflation in the United States for 40 years, essentially. And so, and when you look at like 5-year forward inflation expectations, they go from 8.5 right now. The market is betting 5 years out from now that they'll be down at about 2.7% is what the market's saying as of today. And you look and you go, how could that possibly take place? But if you think about all the deflationary pressures that we have, it all comes back to technology and efficiency. Technology is the ultimate deflationary pressure. And that's what caused inflation to be subdued for the better part of 3 decades here in the United States. Is we just got better at producing things. We would use robots, whatever it is, and it drove the cost of goods down. And that was a deflationary pressure. The internet is a massive deflationary pressure. Think about, the fact that think about this, not just the Amazon effect, but think about back 30 years ago, you would go to the store in your local town, whatever it was, and you would purchase whatever it was without questioning the price.
Right.
Because you don't have a price comparison mechanism like the internet at your fingertips at all times. Correct. So that is a deflationary pressure, a huge one. So at the end of the day, technology is going to continue to be here. We're going to continue to innovate, and that will help kind of get us back to a normalized inflationary environment at some point in the next 5 years is what the market's telling us.
Yeah. The other thing that's going on now that I hope happens is this deglobalization trend takes hold. And frankly, we make more stuff here. That won't be deflationary. That will be inflationary. We pay our people more money, right?
You're right.
Yeah. So what do you think about that? Do you think 5 years, because it takes a long time to build fabs and all of that. Do you think 5-10 years from now, we're building more stuff here?
I don't think so.
Okay.
I don't think it's in the best interest of any of the economies around the world. Globalization, at the end of the day, is us saying, you do what you do best, we do what we do best, and we'll trade. That's essentially what globalization is. Yes, there are some knock-on effects. Germany is facing a massive political misstep that put them in bed with Russia.
90% of oil. Yeah.
Now they're looking at themselves and kicking themselves in the butt and saying we shouldn't have done that. So yes, there are side effects that come. But right now, I think that at the end of the day, there are, U.S. is so tech based. If you look at like the European market, only about 10% of their stock market is technology based. We're about 40% here in the States.
Oh, wow.
And that just shows the innovation that's come out of Silicon Valley. And they are using our technology in Europe. But we're also buying BMWs from them. Like, that's what they're good at, is some of that other stuff. Germany's a massive export economy that's manufacturing based. And they're better at a lot of that stuff than we are. China and some of those Southeast Asia countries have really cheap labor. It's a lower cost of living over there. So why wouldn't we export some of that? And listen, I'm a diehard, grew up in the middle of nowhere American too, but like, I'm also a capitalist that says like, do what makes sense here. I would love to be as efficient as they are, but labor costs aren't going to be competitive here. And we don't want that.
No,
we don't want that.
Yeah. If we brought home 25% of manufacturing, that's inflationary. It just is when the input costs are, I don't know, 10x, 12x.
It is. It is.
It's inflationary. It just is.
No doubt.
So a lot of fun. So again, I think the big thing going on right now, I think we're seeing in the stock market, it started last week. I think it's going to be months, if not quarters in the making, is risk is being repriced. Is that a fair assumption?
100%. And I'll repeat this because we mentioned the last episode, but just in case someone, only listens to this one. Right now, by the end of the year, the market is anticipating the federal funds rate to be between 2.75% and 3%. Right now, it sits at 0.25%.
Yeah.
So that means there's only 7 meetings the Fed's going to have between now and the end of the year. That means that for the bulk of them, that 50 basis point warning we just got, if the market's right, that means the bulk of them are going to be 50 basis point moves. Get used to it.
Yeah, exactly.
And that's what caused this, I always call it puking, and it's a terrible, thought, but that's what happened. Was the market just puked on itself and said, I'm getting out of the way. And Friday was a brutal, brutal downward day. Now, hopefully we can start to see some bottom, but I don't know that it's going to happen in any short term, because right now the trend is sideways and down.
Yeah.
And earnings are okay. About 3/4 of the market, I'm sorry. So 20% of the S&P 500 is reported at this point. About 3/4 have beat, which is right in the screws of long-term average.
Yep.
And so earnings are okay. Projections are okay. But when the Fed is raising rates, it is just something. Get out of the way of it. Get out of the way of it. And I'm not saying don't invest. Don't get me wrong. Not investing is not the right answer, and trying to time the market is not the right answer. But diversification is the answer that I go with 100% of the time. That is de-risking. It's spreading your bets, and it's putting them in different assets that do well in different economic conditions. And that's what needs to be happening right now in order for you to be prepared for when this thing does break. And then when it bounces on the other side.
Absolutely. Taylor, this has been a lot of fun. I look forward to our conversations every Monday. Where can people find you?
Pardon me. They can find me at Life Goal Investments. They can find us at Life Goal Investments on Instagram. Michael, it's a pleasure as always. Thanks so much for having me.
Thank you, buddy.